Welcome, everyone, to the Daily Bread with Tom Hartman. I am your host, Tom Hartman, coming to you with the financial market news for retail traders today. Not a big news day today, except for the fact that it feels like the sky is falling. What with the trade tensions still happening, we have regional banks that spark weakness with a broader sell-off because of the whole shutdown. We also have things where gold is hitting record highs um, as people are scrambling for a safe haven demand. Bond yields are falling. Um, there's all kinds of uh, interesting effects in the AI space and inside of the retail trading space. But the thing I wanted to bring up the most today are two particular posts on Twitter that I thought were particularly interesting. The first one comes from H. Cuppy on X, who points out the Fed governor's repeated stumbles, underscoring institutional incompetence. I thought this was an interesting clip, not very long, but very telling. Let's just go ahead and grab that.
So we were supposed to get an inflation report today. Didn't. Government shutdown. What do you think it would have shown?
Oh, well, that's above my pay grade.
How are you looking at alternative data sources? Like, how are you piecing together what's happening? You're going to have to make a decision
He's the Fed governor, and it's above his pay grade, right?
at the end of October whether the government's open or not.
So I would love to have the data that we need to make the decision. We are fortunate that we only make monetary policy decisions outside of a crisis every 6 months. And so I'm still hopeful that we'll have more data by the time we get to the point.
6 weeks.
Yeah, sorry, every
6 weeks.
Sorry,
Yeah.
thank you.
Yeah. That would be crazy.
Every 6 weeks, yes.
Yes.
So I'm hopeful that we have the data in hand by the time we get to the October FOMC meeting. However, there's a chance that we don't. And if we don't, then I would rely on what I said a moment ago, which is that policy should not be overly data dependent. It should be forecast dependent.
That's not how the Fed operates, though. I mean, how many times do we hear Fed Chair Powell say data dependent?
I mean, I think that you want to be data dependent if you either you don't have a forecast or you don't believe in your forecast, right? Or you don't have.
But if you look at the
forecast.
forecasts of the Fed in the dots, they project their economic and inflationary outlooks. They're mostly not right.
I think that is something that every forecaster should hold them, should hold themselves to account for when they're right or wrong.
That's brilliant. This is a Fed governor who, this is Stephen Mirren, right? Who is, the most surface level talking points when it comes to what's going on at the Fed. So he's talking about here the forecasts that the Fed should be forecast related, which is to say, he's basically saying that the Fed should be setting what should happen in the future. They shouldn't be just reactive to data as it comes in. And there's a case for that. There's an understanding for that, except for the fact that the whole Fed's raison d'etre has turned into this reactive machine that is trying to reduce volatility within financial markets, especially the bond market. They're not looking to set something for guide into the future or say something that'll disrupt markets and have markets have to shift and change in order to try to adapt. That creates volatility and exactly what they don't want, especially since, it's a house of cards built on debt with duct tape throughout the entire world. And it's sort of like, don't shake it too much or it can fall apart, as we've seen multiple times before. So I thought that was particularly interesting. Thanks, Cuppy, for sharing that with us. Next up here is the government shutdown exacerbating bank funding strains. So this comes from Jacob Kinge on X, who says, break-in, regional bank stocks are plunging today. They rely on short-term liquidity, aka cash on hand, to cover daily operations. Weekly government payments temporarily boost their cash via float, but when a shutdown stops those payments, banks must sell assets to stay liquid. Right now, large treasury settlements are draining cash reserves. One moment here. Right. So right now, large treasury settlements are draining cash, and banks are borrowing heavily from the Fed to cover gaps. That selling pressure ripples through the broader market. My theory is that Democrats are intentionally letting this happen. They saw how the tariff crash briefly turned voters against Trump and blah, blah, blah. Okay, so he goes on to talk about the politics of it. But we do see a drop off in a bunch of these banks as these stresses are reflecting to the market. And if they do have to sell assets in order to stay liquid, that could add to the selling that we're seeing on the daily, especially during US sessions. Now, the last thing I wanted to show today, I just wanted to revisit this idea of if we're going to be headed into a recession, um, it behooves us to pay attention to how to survive that. And especially for those who have nice nest egg, their retirement, some funds that they have on the side in order to. That they have saved up on the side in order to live, but that might be exposed to markets. It makes a lot of sense to go ahead um, and protect yourself, to prepare yourself so that your portfolio can withstand different types of regimes that you're in, either booms, busts, transitionary periods in between. And I always found this was interesting. This is a video by Real Vision. It's an interview between Chris Cole from Artemis Capital
Explain that.
Management
Yeah.
and
Because
Daniel DiMartino Booth from shoot, I should remember what she's from. Very popular. We refer to her all the time. Quill Intelligence. There we go. And I thought it was just absolutely fascinating because he goes through the exercise of saying, "Hey, if you had if you had to have a portfolio that would last for 100 years, what would you put inside of it?" So this is the famous Dragon portfolio, and something that's become popular over the years. People reference it constantly, and now with gold being up and especially with gold being up, it makes you wonder, hey, maybe there's something, I should pay attention to this. You don't expect gold to reach $4,000 per ounce. I mean, a lot of people didn't expect it. A lot of people did, but if you didn't expect it, you want to turn to people who said that a large gold allocation is worthwhile and who weren't gold maxis. And Chris Cole is one of those people. So let's just take a few minutes to hear what he has to say here. And if you want to see the full video, please go ahead to my X account. You can click on the link for this daily bread, and you'll be taken to the full video that's been released on YouTube by Real Vision for free. One moment here. Let's just make sure. Okay, so
I was intrigued about how you
Find a asset allocation that is a solution. What asset allocation can work over 90 years that can protect you against the deflationary elements of the left wing of the hawk and the reflationary elements of the right wing of the hawk? That led me to a very big conclusion, and it ties into the question about private equity. Most people think that excess return, that you want to take two asset classes and that both have solid returns and bring them together, and that you'll get a better result from that. That they prioritize the search for yield and prioritize excess return. And what I've found is that actually what people should prioritize is secular diversification. And what that means is that you should look to asset classes that can perform on the left or the right tail and boldly size them in your portfolio. That means boldly sizing counter-trend asset classes that perform when stocks and bonds don't.
so gold's not like the little 10% just in case.
That's right. Gold shouldn't be 1% or 2%. It should be 20%. Volatility should be 20%. Commodity trend should be 20%. And then stocks and bonds can make up the other remaining 20 and 20. Well, so private equity
That
VC.
stands the conventional wisdom on its head.
It does, where many individuals have big problems trying to even allocate 3% of their portfolio to gold. Well, this gets back to the private equity VC question. Now, these are relatively new asset classes. It's tough to see their performance going back 100 years.
Right.
But Cambridge has fantastic data going back a good 20 years, 20, 30 years.
When I was at DLJ, we had a merchant bank. I mean, private equity was this cottage industry. Leon Black used to walk the halls. I mean, this was way before it was, what, they've got $4 trillion?
Yeah, it's massive.
I mean, massive.
Massive. Well, it becomes very clear from looking, you can just look at the return data from private equity and VCs to see that these asset classes are secular growth asset classes. They are correlated to the business cycle.
So they move in concert with publicly traded equities.
They move. You might get, you might get some excess return, but they are correlated to equities. They will lose money in the event that there's a wide-scale recession. That has, I should say they have historically lost money when that has occurred. I cringe when I hear leaders of very large, and I've heard this, leaders of very large pension systems, huge systems that have a lot of money, and they say that private equity and venture capital are diversifiers because they're lagged.
Okay, well, he's very excited by it, and he goes on to explain all kinds of different aspects of it as you take into consideration growth, inflation, policy, the different characteristics for the assets, what's considered long volatility, how you want to actually hold these assets. It's a really fantastic interview that you want to watch a few times over in order to get your feel around it. And I think there's even institutions that offer their versions of Dragon portfolios, although now you're seeing a lot more people making their own portfolio mix instead of the profile, instead of their accounts, their brokerage accounts, or with services like Traders Post that allows them to go ahead and build their own portfolio, build their own allocations, build their own algorithms that balance these things out. But I'm always interested in these sort of things, and maybe you are too. So there's a nice little tidbit for you today on this wonderful October 16th. Okay, we'll be back next week. It's Thursday. We'll be back next week for another Daily Bread. We'll recap what happens on Friday and over the weekend. So we start off Monday fresh as a daisy. Thank you very much for watching, and I've been Tom Hartman.